Rates are in the sixes. People have been waiting for rates to get lower. Here we are. The Fed fund rate being cut is, man, it sounds good, in theory, but last time it didn't work out so good for us. Just word that it's a buyer's market is going to spark interest in buyers, right? Now, combined with a buyer's market and lower interest rates, it's going to be good news to come for people in our industry.
I'm Karl Kyler, your San Diego Realtor, and we're back with Matt from Movement Mortgage. Matt, thanks again for joining us with this update on mortgage rates.
My pleasure. Glad to be here.
Okay, so we've had a lot going on. Just give us a rundown, the update of what has happened with mortgage rates over the last 2 weeks since we last talked with you.
Last 2 weeks have actually been really good, man. Looking forward to a lot of the same. Each day, a little bit better. As we talked a couple weeks ago, we were kind of, wait and see. But as far as the bond market is concerned, things have been looking good, especially this week. I've gotten a new pricing for the better as far as rate sheets are concerned. So in my world, when you get a new pricing sheet and you get that email, you look up, you want to know if it's for the better or for the worse. And this week it's been for the better. So hopefully that's the trend that's continuing. We just ticked below the 200-day moving average as far as the 10-year note. So that's like we've spoken about this last month. The 10-year getting closer to 4% is going to be a big driving factor in the way these mortgage interest rates are working and getting lower. It's going to be unemployment, and it's going to be that 10-year, and the closer we get to 4, the better.
Could you give us a little bit more context on what that means? Like for the audience that doesn't know the significance of the 10-year treasury and then also that 100-day average, could you tell us a little bit more about like what you mean by all that?
Well, there's people a lot smarter than me that run these technicals and the way that these bond markets move, right? 25-day moving average, a 50-day moving average, a 100-day, and a 200-day. And then there's Fibonacci levels that go beneath those and in between those as well, right? Not to get too nerdy or technical, but there's a lot of factors that drive these numbers up and down when it comes to yield spreads and yields coming off of these bonds, right? So the good news is that the 10-year has broken through a lot of these resistant levels, right? They'll test them, and sometimes they'll bounce off them and kind of return back to where they once were the day before or the weeks prior. But this week they've kind of broken through a lot of levels of resistance that may have held them back in the past, and it's looking good in weeks to come. So the news is looking good, which is, like we've talked about again in the past month, it's good news has been the driving force in these markets, and bad news has been driving force in these markets as well. So good news for the markets is good news for us, and we'll take it and run with it. And I'm as you can see, pretty happy about the way this week is turned out, and hoping for a lot more of that.
Yeah, I think any buyer ought to be very happy right now because the conversation is so crazy, and this is probably a little preemptive, but the conversation around the reality of 6.5% interest rates, like I swear it just started popping up everywhere. Like once we beat that 100-day moving average, and then we got to like 6.82, I think it was, or we broke 6.8 or something like that. Everyone's like, all these economists and these other lenders are talking about like, oh my gosh, it's so possible that we're 6.5 is totally within reach. And it's so funny. There's a guy, an economist I follow. He says, don't fall for it. He says all it takes is one tweet and it could turn that pendulum the other way so fast.
Absolutely. All it takes is, one tweet or one misrepresented item in the news, one way or the other that could sway these markets. Hopefully we don't get any of that. Hopefully it's just good news on the horizon. But again, when I'm looking at the chart right now, right, if I flip the screen around, you'd be able to see the trajectory of the 10-year, and as well as the 30-year mortgage-backed securities is also trending well. So good signs on the bond market. Hopefully the trend continues, fingers crossed. But get on the phones, talk to your talk to your people. Rates are in the sixes. People have been waiting for rates to get lower. Here we are. Today's the day. Let's start talking about your next move, right?
Okay, so I'm curious. The U.S. bombed specific sites in Iran. We don't need to go into the details of the war or anything like that or make political stances, but the US took a stance against Iran and there was military intervention. How is that affecting the markets? How does it affect the markets? How will it possibly affect the markets? Can you give us any insight on what might be going on as a result of the war?
So, as a result of any war, right, it could be good for the bond market and interest rates, or it could have a horrible effect on interest rates of the bond market, depending on where on the planet the war is, right? As well as what's at stake. How big's the war? Are we involved in the war? Are we not involved in the war? Are we bringing troops? How much money are we dedicating to the war? All, so many factors go into that, right? But it's, what's going to cause inflation, what's going to hurt job numbers as far as people going away, so on and so forth. So the logistics really matter in that as well. But as far as what's happening right now, the big factor that would have hit us is if something happened with the oil reserves, right? If they would have closed the Strait of Hormuz, that probably would have hit us in a negative way because we would have seen it at the gas tanks, we would have seen it buying the barrels, and inflation would have taken that factor in effect and maybe bumped inflation up a little higher, moving our goal from the 2% a little further away. And it's thank goodness that wasn't the case.
Yeah, I remember the second the whole war situation really started to spill onto the airwaves, price per barrel went up pretty high, and now it's back. I think it's in the 60s. We want to keep it in the 60s, or if it could possibly go sub 60, that would be ideal to support personal consumption expenditures inflation, which is the main one that the Federal Reserve uses. So that's good that I have been seeing that the oil cost per oil is is it tank, or I don't even know what the measurement is.
Cost per barrel.
Cost per barrel. Thank you very much. Cost per barrel. Thankfully, that is showing in that 60s range. So, okay, good. So you touched on inflation. I think that this is a great segue into the next topic. Jerome Powell, head of the Federal Reserve, the president, we had the Federal Open Market Committee meeting just recently where he talked to the public about why they held rates where they were. And behind what he said that we still don't think that tariffs have had their impact on inflation yet. So with everything that has happened, with all of the comments that Jerome Powell has been alluding to, I feel like I'm getting like mixed messages from a lot of people saying like, there's a lot of other Federal Reserve committee members that are saying, hey, we should be cutting in July. And then there's others that are saying, no, we gotta wait and get more data on tariffs. So the majority of people, I guess what they're predicting, or the markets are predicting, is that we won't get our first Fed fund rate cut until September. How is all of this just grayness around inflation, tariffs, when we're gonna get cut? How is this affecting the markets, and how is it showing up in mortgage rates?
You know what? It's a lot of the same with Fed Chair Jerome Powell. You had two members that wanted cuts to come next month, but like we all know, most of the cuts and most of the Fed members themselves expect cuts to come in the fourth quarter, at the beginning of the fourth quarter, September, October range. Here's my own little personal fear is I've seen this tape before. If you look back, you rewind the tape 12 months ago, going into last summer, rates started looking really good. The trajectory is great. No rate cuts as far as the Fed was concerned. And then the minute the Fed cut the rate, it had a negative effect on our market, and the Wall Street went crazy, right? So I'm hoping it doesn't have that effect. The yield spread is not inverted this time around, so that shouldn't be the effect that it's going to have. But again, who knows, right? Fed Chair Powell was talking about, we need to see what these tariffs are going to do, because we haven't seen them really hit the market yet. We haven't really seen what these tariffs and the effect of these tariffs are going to really do on the economy, how much squeeze or relief is going to come of them. Inflation kind of ticked up a little bit this past month, so that I could see why they're a little weary. But again, it stayed pretty flat and has come down over time in inflation concerns. So I definitely see why the other two Fed members wanted the cuts to come sooner. They're seeing the trend downwards to where they kind of want it to be. But again, we all know they want data, and now they want data on the tariffs. So we'll wait and see.
Yeah, that's a really good point. I forgot that last year when the Federal Reserve did cut rates, mortgage interest rates did bump up a little, right?
A lot of
got it.
Yeah, mortgage rates bumped up a lot, and both times, right? They cut in October, and then they cut again in November, and both times it was the bond market that took the hits. The yields went up, and of course, Wall Street went big. Everybody put their money back into their 401ks. Everybody put, money back into the S&P 500. So that's the turn that when the banks gave themselves the breaks of lending money, that's where the rate went, and that's where the relief came. It didn't come in mortgage-backed securities, and it didn't come in 10-year treasuries.
Got it. I think that's a really, really important point that people should take from this video. I have a client, not even a client yet. He's someone from the community that my wife and I are heavily involved in. And he keeps saying, oh, we're going to wait for the Federal Reserve to cut rates, to lower mortgage rates. And no matter how often I have this conversation with him, like, hey, those don't directly influence mortgage rates. When the Federal Reserve cuts the Federal Reserve rate, the federal funds rate, there's not a direct correlation there. And so it's interesting that people should really, really pay attention and just remember or even, fact check this video, go and look back in October and December of when the Federal Reserve cut the Fed funds rate, and then look at mortgage rates and how that was ticked up. So that's really, really good. Thank you for pointing it out and reminding the audience of that.
Absolutely. No, and you want to talk about data. I look at the MBS Highway, right? It's a great tool for us lenders. Anybody who's doing anything residential mortgage wise should definitely be on this MBS Highway. Plug for free, but it really gives us the data that we need. And I can back this screen out right now and show you exactly what was going on this time last year. But no, and knowing kind of what that question coming up and the Fed fund rate being cut is, man, it sounds good, in theory, but last time it didn't work out so good for us. So we're hoping it's a little different this time around. But again, when the Fed fund rate gets lowered, it's lowering the rate that banks lend money to themselves, not so much mortgage interest rates.
Gotcha. I feel like, and this is very just anecdotal, so my experience, I feel like when the Fed cut the rate, I don't know the data on this. Maybe it's something I can look into, and if I can, I'll put it on the screen. It seems like when the Feds cut the rate, it kind of sparks interest in consumer perception. It's like, oh, the Fed funds rate is coming down. Everything's gonna get less expensive. And it's just, they don't know any better. And then they start to ask questions and get more inquisitive about the market, and they get into it. So let's use that as a segue. The fact of the matter is that the Fed funds rate has not been cut. It's not making an influence on rates in a positive way yet, but rates are coming down. Can you tell us anything about mortgage applications with rates having come down? We've seen lots of data in the past that once they get closer, they trend down, we start getting more interest and new applications start to go up. Are you starting to see that yet?
I am starting to see it, and I am starting to get more and more interest, right? Not only on the purchase end, but past refinances, right? Good news in the world sparks interest, and good news and people who are wanting to save money on their mortgage payments, or people who have want to move around some debt, or just people who just want to talk and see what's real and what's really going on with their mortgage, with the market, what to expect, and just kind of do a recap. And hopefully, if I'm doing my job, I'm reaching out to them and they're not reaching out to me. But either way, you want to have these conversations right now because it's trending in the right way. Hopefully the good news continues. But as far as applications and interest, yes, and I expect a lot of the same, especially with more and more videos like this and more good news on the horizon. It's just going to spark those applications. And now you've already kind of heard on the, word on the street, it's a buyer's market, even though here in San Diego, we know that's not really going to be the case. Maybe nationally they're feeling it in different markets, more of a buyer's market, but just word that it's a buyer's market is going to spark interest in buyers, right? Now combined with a buyer's market and lower interest rates, it's going to be good news to come for people in our industry.
On that topic of buyer's market, that is something I've been reporting a lot on in my San Diego Market Matters. So if you're watching this video, you want to hear some of the recent updates on buyer's market trends, who specifically, like what major metro areas are in a buyer's market, I have those videos covered in my past San Diego Market Matters that drop mostly on Sundays. San Diego, I feel like we're in a position where Redfin reported we have like a surplus of, I think it's 14% buyers to sellers. And if you look at US, so you have your buyer's market, your seller's market, and then you have that neutral market. And that neutral market doesn't tend to last for very long. And I feel like we're on this precipice of either like we're in the neutral market and we're about to tip back into a seller's market. And I'll use seller's market very, very loosely in this context because it's not going to be like the seller's market we've experienced in the last 4 to maybe even 7 years to like 2018. It's going to be more of a manageable seller's market, probably closer to what we experienced 2013 to 2017. Or it could tip the other direction where, like, especially if rates don't come down, like say they shoot back up to 7% solid and the buyer affordability issue just becomes more pronounced, buyers aren't able to get in. So this is really, really interesting to share this data. Okay, that's it for this video. If you have any thoughts, questions, concerns, if you're interested in capitalizing on where rates are right now, do not hesitate. Give Kish a call directly. His contact info is in the description below. He is local. He is a San Diego. He is my preferred vendor, my preferred lender here in San Diego. Give him a call directly if you have any thoughts, questions, concerns. Don't hesitate to reach out. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.